Your money is disappearing right now. Not stolen, not lost, just vanishing. And the worst part, you're helping it happen. Every single day, millions of people wake up, go to work, earn money, and think they're building wealth. But here's the truth. Nobody wants to admit that paper in your wallet. It's worth less today than it was yesterday. And tomorrow, even less. This is just how inflation works in modern economies. And once you understand it, everything changes. Let me paint you a picture. Imagine you worked all month for $2,000. You deposit it into your bank account, feeling good about yourself, responsible, smart. But here's what actually just happened. Fractional reserve banking. Banks lend most deposits to keep the economy moving. The government took a chunk before it even hit your account. And inflation? It's eating away at what's left every single second. Let's start with how you got that money. You traded something incredibly valuable for it. Time. The one thing you can never get back. You gave 40 hours of your life, your energy, your focus. In return, you got numbers on a screen. But here's what most people don't realize. You were trained from childhood to believe this is normal. Trade time for money. Work until you're 65. Retire and finally enjoy life. If you're still alive and healthy. But before you even see that money, the government takes their cut. Not a small cut, a massive slice. Many countries have simpler tax systems, but the US relies on self-reporting, which creates this complexity. There's income tax, which is supposed to fund roads and schools and all that good stuff. There's Social Security, money you'll hopefully see decades from now when you're old. There's Medicare, paying for healthcare for others right now. And here's the kicker. The government knows exactly how much you owe. You might be wondering, if they already know, why do I have to calculate it myself? Good question. In countries like Japan, Sweden, and the UK, tax agencies send pre-filled returns. You review them, sign off, done. But the US uses a different system. You calculate, you report, you file. Get it wrong? Penalties. Why the complexity? Partly policy decisions, partly lobbying. Tax preparation is a multi-billion-dollar industry, and it benefits from the current system staying complicated. Not a conspiracy, just incentives. And the more you understand how these rules work, the better you can navigate them.
So after taxes, where does your money actually go? The bank. Most people imagine a vault. Steel doors, armed guards, their money sitting safely in a specific drawer with their name on it. That's not how it works. The moment you deposit money, the bank puts it to work. This is called fractional reserve banking. Here's how it works. You deposit $1,000. The bank keeps maybe $100 on hand, enough to cover daily withdrawals. The other $900, they lend it out to someone buying a car, starting a business, buying a house. Your deposit becomes someone else's loan. This isn't a scam. It's how credit economies function. Banks act as intermediaries, moving money from savers to borrowers. But here's what makes this interesting. Banks pay you interest for depositing your money. Maybe 1%, maybe 2% if you're lucky. Then they lend that same money out at much higher rates. 7% for a car loan, 5% for a mortgage, 20% on credit cards. That gap between what they pay you and what they charge borrowers is how banks profit. You're essentially providing the capital. They're providing the infrastructure and risk management. And if you understand this, you start asking a different question. What if I could be on the other side of that equation? What if my money could earn the higher rate instead of the lower one? That's where investing comes in. But before we get there, we need to talk about the force working against you every single day. Inflation. You felt it. Groceries cost more than they used to. Rent keeps climbing. A coffee that cost $3 5 years ago now costs $5. Inflation means prices rise over time, which means your money gradually loses purchasing power. Here's why this matters. If you save $1,000 in cash and inflation runs at 3% annually, that money buys about 26% less after 10 years. You didn't spend it, you didn't lose it, but its power quietly eroded. Central banks actually target modest inflation, usually around 2%, because it encourages spending and investment rather than hoarding cash. But over decades, it compounds, which means holding cash long-term is a guaranteed way to lose purchasing power. So what causes inflation? Sometimes it's demand. When everyone suddenly has more money, stimulus checks, for example, and they're all competing for the same limited goods, prices rise. Sometimes it's supply. A factory shuts down. Shipping gets disrupted. Production costs spike. Those costs get passed to consumers. And sometimes it's expectations. If people believe prices will rise, they buy now instead of later. That creates demand, which raises prices, which confirms their fears. Psychology becomes economics. Governments try to manage this by adjusting interest rates. Raise rates, borrowing becomes expensive, spending slows, inflation cools. But push too hard, and you risk recession. It's a constant balancing act. Now here's where things get interesting. Interest works two ways. When you borrow money, it compounds against you. A small credit card balance at 20% interest can spiral fast. That $15 lunch you didn't pay off immediately, it grows, compounds. Before long, it cost you $40, then $60. But flip the equation. When you invest, compound interest works for you. Let's say you invest $1,000 at an average annual return of 8%. Year 1, $1,080. Barely noticeable. Year 10, $2,159. Year 20, $4,660. Year 30, $10,063 from $1,000. You didn't get lucky. You didn't time the market. You just waited. Time did the heavy lifting. This is how you protect yourself from inflation. You can't stop prices from rising. But you can put your money where it grows faster than inflation erodes it. Stocks represent ownership in companies. As businesses grow, your shares become more valuable. Bonds are loans to governments or corporations that pay you interest. Index funds let you own hundreds of companies at once without picking individual winners. Real estate generates rental income and can appreciate over time. Different assets, different risk levels. Same core principle. Growth potential that outpaces inflation. Since 1926, the S&P 500 has averaged about 10% annual returns. Some years up, some years down. But over decades, the trend is clear. That's not luck. It's historical pattern. And here's the most important variable in all of this. Time. Not income, not intelligence. Time. Someone who starts investing $200 a month at age 25 will massively outperform someone who starts investing $500 a month at age 40. Even though the second person contributes more money. Why? 15 extra years of compound growth. The first investor's money had more time to multiply. This is why wealth isn't built in days or weeks or months. It's built in decades. Most millionaires didn't win the lottery, didn't inherit fortunes, didn't get lucky with one big bet. They invested consistently over long periods and let mathematics do the work. Let me give you a concrete example. Meet Sarah. At 25, she started investing $250 per month into a low-cost index fund. Nothing fancy, just automated monthly contributions. She earned an average salary, never made six figures, but she stayed consistent. By 55, 30 years later, her account had grown to over $600,000. She contributed $90,000 total over those 3 decades. The other $510,000? Compound growth. She didn't work harder in year 20 than year 1. Time multiplied her effort. That's the pattern wealthy people understand. Investing isn't about luck. It's about time. Now, one more system controls a lot of financial opportunity in your life. Your credit score. This 3-digit number, ranging from 300 to 850, estimates how reliably you repay debt. It affects loan approvals, interest rates, sometimes even housing and employment opportunities. It's not a measure of wealth. It's a measure of reliability. Below 600? You'll struggle to get approved for loans, and if you do, the interest rates will be brutal. Above 750? Banks compete for your business. You get the best rates available. Most people sit somewhere in between. Here's the thing. You can have zero debt and perfect finances, but still have a weak credit score. Why? Because the system tracks repayment behavior, not avoidance. It rewards people who borrow responsibly and repay consistently. The paradox is you have to use credit to build credit. But once you understand the rules, you can build a strong score strategically. Let's zoom out for a second. What is money, really? Look at a dollar bill. It's paper, ink, security features, but it has no inherent value. You can't eat it, can't build with it. So why does it work? Because we collectively agree it works. Modern currency is built on trust, government backing, economic stability, shared belief. The same reason Bitcoin works for some people, or gold worked for centuries. Value isn't in the woo itself, it's in the agreement. And that agreement holds as long as governments remain stable. Central banks manage supply carefully. People continue to trust the system. History shows that when governments print too much money without matching economic output, that trust breaks. We've seen it in extreme cases. But in stable economies, central banks actively try to prevent that. It's a balancing act. Print enough to fuel growth. Not so much that value collapses. So let's connect everything. Your paycheck gets taxed to fund public systems. Banks use your deposits to fuel lending and economic growth. Inflation gradually reduces purchasing power over time. Compound interest either works for you or against you, depending on which side you're on. Credit scores gatekeep financial opportunities. And currency itself only works because of collective trust. None of this is hidden. None of this is a conspiracy. It's just how modern economies function. The system rewards people who understand these mechanics. Most people never learn them. Not because anyone's hiding the information, but because financial literacy isn't prioritized in traditional education. So what do you do with this information? First, start investing. Even small amounts. $10, $50, $100 a month. The amount matters less than the habit. Open a brokerage account. Set up automatic contributions. Invest in low-cost index funds. Let time do the work. Second, understand debt. Avoid high-interest consumer debt. If you have credit card balances, prioritize paying them down. The interest working against you is brutal. Third, build your credit score strategically. Use credit cards responsibly. Pay them off in full each month. Build history. Fourth, Invest in skills that create value. The wealthier you become, the more you'll realize income isn't just about hours worked. It's about value created. Learn skills that scale, build systems, solve expensive problems.
You don't need to be rich to start. You don't need connections. You don't need a finance degree. You need understanding, consistency, and patience. The system isn't broken. It's just complex. And complexity rewards those who take time to learn the rules. You can ignore all of this. Go back to trading time for money. Watch inflation quietly erode your savings. Wonder why you're not getting ahead. Or you can choose differently. Small, consistent actions compound just like interest. Someone who starts today, even modestly, will be years ahead of someone who waits. Not because they're smarter, because they started sooner. Your money is losing purchasing power right now, but now you know why. You understand the forces at play: taxes, banking, inflation, interest, credit, time. These aren't mysteries, they're mechanics. And once you understand the mechanics, you can use them. The question isn't whether the system works, it's whether you'll learn to work with it.